Hello, how are you all doing today? By the way, I'm going to point out that we're handing out some Bitcoin. Everyone in the first row gets 1 Bitcoin. Everyone in the second row gets 1/4 of a Bitcoin. By the time you get to the back, it's really worthless, and you're paying us. And so the people in the back actually pay the people in the front to sit there. And if that hint in humor wasn't enough, in a minute I'm going to start screaming people's names that I know that are sitting in the back and forcing them up to the front. So come on, come up front. We're a little thin for a lot of reasons, but let's get homey and be friends and get up closer. And I really mean you, Steve, and your crowd. Come on, Steve, you can do it. And there's what is that? Decred people in the back? Come on. I understand that Factum and Decred are competing at this conference, but we don't mind. As long as we win, we're pretty friendly to you Decred people. All right. Surprisingly enough, this presentation is going to be relatively short. We're going to spend more time answering questions, I'm almost certain. Okay? Now, what Factum is doing here and what I'm doing here is presenting an idea that is relatively straightforward. There are some people out there like Haven and BitShares that came very, very close to implementing what we're suggesting, but the models were a little different, and as a result, it's not quite the same thing. So we're going to be talking about market-driven peg tokens. Now, we call them stablecoins because the idea is to be able to send around USD or Euro or something like that as a token and have it be worth $1 or €1 to anyone that decides to cash it out in some way. And so we call it stablecoins. Peg tokens can certainly peg to these stable coins, but they can also peg to things that aren't necessarily as stable, like gold or Bitcoin or, I don't know, the S&P 500. Or, you know, I don't know, any basic market-driven computable economic value. All right, so why do you need stable coins? This is a slide that I'm going to throw up here. Most of you realize that if you're going to put a payment into a smart contract, it'd be really good if 3 months from now it was the same amount that you put in the smart contract as when you started. Unfortunately, at various periods of time, the value that drives a smart contract based on Ethereum might be a really good deal in 3 months or a really, really sucky deal if the market went against the token. So if you have a stable value, that gets you a great deal of benefit in today's world. And by stable, we're talking about the ever-diminishing value of the USD. It's just what we happen to price things in. So over 3 months or 6 months, most people consider the USD payment today to be the same as 3 months or 6 months down the road. And I have all these other things. If you're in the crypto world, it allows you to trade against USD or euros or yen or whatever on an exchange, even if the exchange can't actually have the bank accounts required to hold those assets. Okay? So, this is the big slide. How do you do it? Well, the first thing you need is a base token and some tokens that you're going to use to peg to values. Okay, so you have to be able to create these tokens and trade them. All right? You need an oracle that provides your market data. So this is given a dollar-based token in the market, what is that in terms of something? So, for instance, let's say I'm going to build all my stable tokens in reference to the dollar. The dollar oracle is really easy to implement. It's the constant 1. Okay, I'll repeat that in case you didn't follow. A dollar should be worth $1. All right, I'll take a question here if anybody is confused about that. All right, okay, we're not. So the euro has some value in dollars, and so I need that pegged, that value from the market. That's where I really need the oracle. I need to get the oracle to go out and say a euro right now is trading at, you know, whatever it's trading at. And if gold is in there, it needs to give me the value of gold in dollars and the value of the base token in dollars and all that sort of thing. So the oracle is really important. The last thing is an issuing authority. The issuing authority is an authority that can destroy one token in this system and create another token in the system. So if I have a USD token, and let's say Factom was involved and there was a factoid out there for $5, then the issuing authority would be able to kill 5 USD tokens and throw them away and create one Factom token. Okay? And this is the implementation. You have the ability to create a conversion where a user holding one of these tokens can, on demand, create any one of the other, this is other token. Somehow it got deleted. Oh well. This is Max fighting with Linux. I'm sorry. Apologize for that. So this is the implementation. I just create a conversion function. Given this, give you that based on the oracle value. And that's it. That's the implementation. A set of tokens and a conversion function. So why would this work as a stable token? Well, that's because you have exchanges out there, and given one token and another token, I can trade them, maybe directly or through an intermediate Bitcoin, whatever, but I can exchange one token for another on exchange. Inside your wallet, you'd be able to just convert as you want based on the oracle. And that creates an opportunity for arbitrage. And so what happens if T2 is below its peg? So it's running around at 90 cents, okay? Then on the exchange, I can take, relative to T1, let's say T1 is just fine, but T2 is running below its peg at 90 cents. Then what I can do is I can buy the cheap tokens on the exchange while simultaneously in my wallet converting back. Boom, 10% without changing my market position. And I can keep the 10% in whichever token I like. Do I get more T1s or more T2s? That's my choice. But I'm going to end up with more because the value's low. And look at what it does to the supply. Since I'm converting from the low-priced T2 in the wallet, burning those to create the T1s, the supply is going down on the undervalued token. What happens when the supply of a token goes down? The price goes up. Also, it works the other way around. If T2 is too high, now what I want to do is buy some of my T1, because I can buy a lot more T1 than I should be able to buy, and I take my T1 and convert to T2 at the correct price, which increases the T2 supply, as well as on the exchange forcing the price up. And then to rebalance your positions, because you're an arbitrager who just looks around for every time the value is a little off and you can make some money, I'm going to deposit some tokens into the exchange here. I'm going to take the T2 and I'm going to deposit into the exchange so I'm ready for the next arbitrage opportunity. That increases the supply of T2 on the exchange, as well as the T2 in general. Okay? So, one of the problems with this is that if you create a base token over something, a tradable token like Factom, if I create it like this over a Factom, then if the interest in the token decreases, like let's say we are pegged to USD, and let's say USD is increasing relative to Factom, in other words, our price is falling, then people are going to either go on the exchange and sell the token. That's certainly an option. That's what they have today, which further depresses the price of the token. But they also have the option of converting their Factom to USD, which lowers the supply of the factum, and increases the supply of USD. If factum starts to go up, it can go back the other way, right? And if the market trades are happen in certain directions, it could increase the supply of factoids quite a bit, which is a bit of a problem. So what we really want to do is have a number of tokens. So you have your base token, whatever it is. I wonder if this thing will shoot a laser. Boom! No, it doesn't. Okay. So, if you have multiple options, let's say you have gold, Bitcoin, and USD. When Bitcoin is going up, people want Bitcoin. They flow to Bitcoin. When Bitcoin's going down, they flow to USD. That makes more sense. When you think the whole world is going to crash and the whole financial industry is going to melt down, you want gold value. So the more options you have, the more mechanisms you have to stabilize the token. So if gold is a little undervalued in the system at one point, but USD is higher valued in the system, let's say only 2 or 3% each, it's the total percentage off that matters to the arbitrager, which means they have a 6% spread. They can make more money bringing gold back in the line to USD. So the idea is, in this system, the way you protect the system and you keep the system stable is you create a network of tokens so that all the tokens help stabilize all the other tokens. And the implementation is I create conversions. Now, there's some observations to make about this. One is that a single address is used to index the balances for all the tokens, which means when you do a conversion, there's no change of location or change of control. That's important because that means you're not a money service business, money transfer business, because there's no money movement and there's no transfer movement, because it's you, it's not anyone else. It also means that it is controlled by every address in the system. So everyone holding the base token is controlling the issuance. And eventually, when all the tokens are funded, anyone holding any of the tokens is controlling the issuance or the destruction of the tokens. In other words, it's not manipulation. There's no market manipulation. There's just the ability to do conversions, and it's what individual people all through the protocol are doing that's maintaining the stability of the price. So there's no accusation that I'm algorithmically creating a stable coin by market manipulation. This is an accusation that has been made by tokens that don't have reserves. So the way to not manipulate the market is to not manipulate the market. Also, there's no contract. It's a conversion. It's just another transaction. There's no special magic. You sign the transaction, you put it in the blockchain, the conversion occurs. The conversion has a zero value effect. There's no gain or loss in value relative to the information the oracles are provided. Therefore, there's no gain or loss in a conversion. And there's no liquidations. So people that are holding, in some of the other algorithmic tokens, you create mechanisms to liquidate people when the risk is too high and allow other people to buy in order to maintain the peg, through basically derivatives on a blockchain. And there's no derivative here. There's no contract. There's no future contract. And since it's all in the hands of the users, it is as distributed as we can make it. And I believe, the oracles in a system like Factom, we have a data layer. And because we have a data layer, we have the ability to record, we create identities for all the oracles. So the oracles have, at least from a blockchain perspective, a digital provable identity. And they're providing data, and we can see that historical data. And then anyone in the system can create tools that demonstrate that an oracle is working really well against historical data or really badly against historical data. And so having the data layer and the ability to go on record and sign all the data from every source and manage that data, we have a way to create greater trust by the market looking at how the system works, because all of the mechanisms are right in front of everyone. I would challenge you to look at any of the other stablecoin implementations out there and ask yourself, how does it really work in the real world? What are all the moving parts? Reserve tokens have massive moving parts in the auditing and the bank relationships and all of the government regulations and approvals, and even restrictions on how you can convert those tokens and who can convert them. In this system, it's just like Bitcoin. If you have an address, you have every right that anyone else has, even if you live in Peru or Botswana or England or US or China. Now, my initial guess is to use these three and as the initial peg tokens, because Bitcoin is clearly not tied to the USD value. If you've been looking at Bitcoin charts, I bought in originally at 75 cents. It's a little more than that now. Certainly, these two tokens are not related. Gold is somewhat not related to USD either. And so what you really want is a network of tokens that are independent in the market to create the most stability, to create the safe haven for people trying to manage their value. You want it distributed across the economy. This is just a guess. It's a wild stab. So if we actually implement this, what we actually do could be something else, but this is an idea. Now, here is the really, really cool thing. There are a lot of economies out there that have problems with their dollar, call it a token or peso or bolivar. And if they created such a system where they wanted to create a more stable value, what they would have to do is break down and be honest, create an open market. Step one. They're a central bank, so they can create the tokens. That's not a problem. And they can pull the market data from it. See, they have all those three requirements: the ability to implement oracles, the ability to issue tokens, and the ability to have an open market. If they have massive inflation like Venezuela, I've heard numbers everywhere from 400,000% per year to 1,000,000% per year, then the token might not be able to hold. Let's say they want to do a dollar peg token, they may not be able to hold a dollar. In other words, the inflation is so great that your arbitrage only makes you money if the price variance is like 40% or 60% off. Like, there is a point where you can move through the market and do your exchange trade and do your central market trade, and you know what your currency risk is. You see what I'm saying? Because if you're trying to catch a falling knife, you have to figure out how far is it going to fall before you can get out of it again. Are you following me? Obviously, the direction you're going to want to go is USD, because who wants to hold something that's falling 400% per year? Raise your hand if you like to lose money. Thank you, Linda. At least I get one hand. All right. So what happens is the vast supply of the bolivar in an overheated market gets burned going to the USD. And as you lower the supply of the hyperinflated supply of the token, of the dollar, you eventually get the supply down that it's no longer falling. And you've traded it for USD that you're maintaining as stable in the market. So it probably really does work to allow third world countries to issue USD value. This just is very mind-blowing. But anyway, I just wanted to throw that up there so that everybody can think about it. That's really the presentation. And I will answer questions. There's a mic here you can line up. If you're in the front, you're in much better position. So I was looking out for you when I asked you to move forward. So go ahead.
Thank you, Paul. Can you go back to the definition of an issuing authority? That was an earlier slide. And are there barriers to entry? What does it take to be an issuing authority? There, that third bullet, right? Thank you.
Well, a central bank can issue money, and a blockchain can issue money. So really anybody building issue tokens. You need to be on exchanges to have establish a value. So I'm not really sure that it's that easy to create a blockchain to work with this unless you already exist. And I think it also helps tremendously if the underlying value has utility. And in our case, the utility drives the documentation of all the oracles as well as every other application running on Factom.
Hi. So is Factom creating its own stablecoin or stablecoins as you're showing on the slides?
We might. But at the point that we are now, I've largely implemented the technology inside of our protocol just as a test. And it's really tough. I have to write a conversion function. That's really all I have to do. But we have to test it. So but where we're at now is to create a fully functional version and figure out how to test it inside of a test network and make sure that I'm not completely off base on some critical point.
And you theoretically think it's possible to create a token that would track the value of something like Bitcoin or gold? So, if you could trade Bitcoin, fine, or you could trade the Factom Bitcoin tracking token?
Yeah.
Is that the idea?
Yeah. And so the idea too, as far as Bitcoin is concerned, is that when Bitcoin starts moving up into the $200,000 range again, I'm a Tim Draper fan. He was an investor in Factom. So when it moves into that territory, transaction fees are going to go massively high. So how do you pay for your coffee? Well, if you're buying a Bitcoin tracking token, then you can have your cake and eat it too, because the tracking token doesn't have to have the same fees that Bitcoin has. And yet you're not losing out to Bitcoin's rise by holding that token. So it's like side chains, but it's using the exchanges to manage the value transfers. Now, people that want to hold it a long time are going to buy the Bitcoin. So it creates a mechanism to go into Bitcoin easier as well.
Can you explain how Factom Harmony and the mortgage stuff integrates with all this?
It probably doesn't initially, but as you start looking at any of these things where you're doing embedded systems and you're doing it inside of financial institutions, then the ability to move value and do it in a way that can be tax neutral, then this is adding more features and assets or abilities to this system. So basically, this is you could think of this as another way of addressing some of the problem space that Ripple targets, and that is there is a way to transfer value very fast to someone else in another country or between institutions that they can count on and speed up transactions, because it wouldn't be reversible.
I just wanted to confirm that I have an understanding of what this implementation is. So I'm going to summarize my understanding and tell me where I'm wrong. So if the factoid, the currency for the Factom protocol, is at $10, I can take one of those and I can burn them for a Bitcoin stablecoin, a gold stablecoin, a USD stablecoin, S&P, whatever it is you implement. And I get $10 worth of that stablecoin because the factoid is at $10. I can then trade them per normal, like the recent USD implementation on Circle. I can do whatever. at some point I can convert them back to factoids and get $10 worth of factoids, even if the factoid is at $20. So I then get a half factoid, and that's where the stable mechanism comes into play?
Yes.
Where I always get to keep my $10.
Yes.
Okay. And this is fully on blockchain. There's not a third party coming into play.
Right.
And it's fully auditable.
Right.
And no one can stop me from doing this.
No.
Thank you.
Again, let me test my understanding. I've got 3 bases here. I've got, and if I express them as countries,
Yeah.
okay, it's a bias, but I've got China playing on the Bitcoin side.
Sure.
I've got the US dollar, and I've got whoever countries have actual gold mines,
Yeah.
enough to sustain a rush. Now, I have 2 of those entities in a trade war.
Yeah.
And we're going to have to go back to the original 1930s or whenever that idea was set up, that it's the currency that moves to balance trade, not excess labor in another country or some country. Anyway, I don't want to get into the politics side, but what's the scenario like if we have a run like that, like
A
trade imbalance, shifting the policy for addressing a trade imbalance back to the original idea?
A currency war where
Yeah.
where you're manipulating. This,
No, I'm not manipulating. I'm just
But no,
trying to
no,
maintain
countries.
my balance of trade every year.
As a country or as
Yeah.
an individual?
Yeah, as a country.
Okay. I'm not sure if I can quite answer that because I'm not quite sure how. I will tell you this. The PEG tokens are going to track what the oracles tell you them, regardless of why the oracle values are what they are. So for example, where Argentina has historically manipulated their currency price in trading to the USD, the dirty secret is nobody ever buys USD from the banks in Venezuela because their exchange rate is ridiculous. They buy them on the black market where they can get where the value is correct.
The fourth candidate is also the yuan.
What's that?
So 2 things. The fourth candidate for your 3 currencies is the yuan.
Yeah. Oh, the yuan?
Yeah,
The Chinese one, not the Korean.
Yeah. Yeah. Oh, right. But yuan has historically, but it's being traded now. So maybe the market value. As long as the market value is what the market value is, inside the blockchain, I can't tell why the oracle numbers are what they are. So I don't think I don't know how to answer that. Let's just go somewhere where I can answer. I can answer what juggling is.
Hey, thanks, Paul. I have a quick question. Could you speak at all about any technical hurdles that still need to be resolved before you feel that this is mature enough for full adoption?
I don't really see any significant hurdles beyond analysis and testing, but testing and analysis is hard. So there you go.
That's fair. And if I may, one other question. Have you done any modeling that answers how this might affect related commodities like, say, Bitcoin, how it might affect like the market volatility coming from simply market sentiment, like people buying and trading based off of the price of it? If there's a better vehicle to express that energy in the market with lesser fees like you've described, do you think that there will be less manipulative action on the major currencies that this is kind of representing indirectly?
It might counteract some of the manipulation because the conversions are at market price. And so it means that temporary price pegs, depending upon how the oracles work, whatever the price peg in the market is, it doesn't necessarily translate cleanly into what's going on inside of the oracle. So that creates some oddities where you have large dumps and large purchases, like the Ethereum dump that drove it to 3 cents on one exchange. So I've looked at that to some extent, but I don't know, really without having the system running, I don't know how it will impact it.
Fair enough. Thank you.
My feeling is that it will average it out, because anyone seeing that kind of activity on the market knows what they can do with the value inside of a system like this. At least they know that the system is a bit more stable because there's a bit more averaging going on by the oracles.
Okay. Thank you very much.
Sure. Any other questions? Come on, Reed, you've got a question. I do want your question. Come on, Reed.
So you have gold that you're going to use inside of this stablecoin, and it's going to be done on chain, correct?
Mm-hmm. Gold value, yeah.
So right now, the GLD ETF charges 40 basis points. How are you going to offset that inside the stablecoin?
I'm not entirely sure, because there's not going to be any direct arbitrage against actual gold with the stable token. So what happens inside of this system is tracking a number defined by the oracle. So if it's a better deal to invest here than it is inside of the gold markets, it becomes a competition for where you invest in gold. Because keep in mind, I'm going to make a supposition, and I'm open to arguments. Traders want to make money. Any arguments? So what that dynamic does, I don't know. Let's say this became a really, really common mechanism in a lot of systems, then it may limit what people trading gold can charge to do trades.
But if you don't have the physical gold,
yes,
then how are you going to keep it stable? You're going to just issue more tokens, which is not actually gold.
Right.
So those can go down to zero.
They can, as long as everything else in the system goes down to zero. There are still arbitrage opportunities that are enforced by the protocol.
And then I just...
By the way, for those of you that don't know, Reed is the filter for the conference to keep scams out. Every time we get a thing from, company X.io, we send it to Reed and we say, "Is this a scam? We don't really believe this website." And he comes back, "No, you can't believe these guys are terrible. You don't want to touch them." That's my best Reed imitation. Come on, you can give it to me. Think of a scam and tell me how you talk about it. Oh, come on. You can't do it on demand.
I can't do
That's
it on
fine.
demand. It just happens.
Yeah.
And so what about if you have a fund or a hedge fund and they just short everything that they can because they're trying to break it?
Mm-hmm.
Right?
Short all these tokens.
The stable coin, because it's stable, it's pegged to $1.
Yeah.
So now if I short it and you're just going to issue more back to $1, anytime it starts breaking, they're always going to short $1's worth of that stable coin. There's only downside for the stable coin.
Go ahead here.
All right, so let me see if I can help everybody out here. I know that hedge funds are dying for a token that they can trade that follows something like physical gold, because GLD is really, it's just paper. It's not backed. If he could create a token that actually tracked the physical gold market, the number of people that would start trading that would be shocking, right? Because my question was, what happens if you actually make this work and the whole world wants it all at once? Are you ready to scale this thing if you could do it? Or is this just like, I thought of this one night?
In that regard, this is one of the reasons this is attractive to us as a protocol is that we want to create utility in the protocol, and we want to look at the ratio of protocol stress to protocol value. This is very, very high value for very low stress. And the reason that it's very low stress is when you trade on an exchange, that is not on the blockchain. So the reason that you can trade Tether all over the place, despite the fact that it's implemented on Omni, which requires Bitcoin transactions, and it did so even when Bitcoin was $20,000 and you had like $80 transaction fees for Bitcoin transactions. Tether was traded all over the place because all those trades are in the exchanges. They're not on the blockchain. So,
Your stuff's on the block. Your stablecoin is on the blockchain.
well, our stablecoin is a blockchain, but on an exchange, it's not on the blockchain. It's off the blockchain. So we can support however many transactions exchanges want to do on the exchange. And this is another thing about stablecoins. They tend to be sticky. Once the token is ended up on the exchange, then what happens is people trade there. They don't bring it back into their wallet and do anything with it, unless you're an arbitrager. I believe that arbitragers will be doing this, but everyone else will be putting their tokens on the exchange and trading them as if they're tokens on the exchange. Yes, sir.
Can you envision a time in the future where people could pick their own baskets? So you just have a whole menu and you just click whatever baskets?
As a token, so a token that represents a arbitrary basket of tokens?
In terms of the gold, dollar.
Right.
Yeah.
Yeah. This is getting into the area of non-fungible tokens, because if you get to pick your arbitrary basket, then I have to create a synthetic representation of that arbitrary basket. And everyone that exactly picks the same arbitrary basket, I certainly could, if that was a high demand, could create a tradable token. But I see that as something that could be done, but not really likely anytime soon. Yes, sir. This is Greg.
Instead of using the dollar or the yuan, have you considered like a special drawing right? Because that's a basket, speaking of baskets, right? Of all the 4 or 5.
I have. The options are massive. You can go look around and you can say, well, what about Berkshire Hathaway? Wouldn't it be really cool to be able to get $5 of Berkshire Hathaway? You can't do that today, at least not in. And what if you're in a third world country and you want some exposure to the stock market? So yeah, I've thought about it, but haven't really considered it too heavily. Yes, sir.
Paul, I came in late, so if you cover this, I apologize. Last year at the conference, there's this guy named Anthony Blanchard.
Yeah.
And he had something that kind of looks like this because it was gold backed. How does this relate to that or fit in with that?
Okay, there are 3 ways to build stable tokens in the world today. And the first way and the most obvious way is asset-backed. So asset-backed tokens are things where you actually hold the gold, or you actually hold the dollar, or you actually hold the euro, or the Swiss, whatever they have, franc, is it? I don't know. And that's what Anthem's doing. He's creating a reserve and a token behind that reserve value. The second way is to use crypto assets in some interesting ways so that the value is backed by crypto. That can be done inside of smart contracts. It can be done by centralized parties. The problem with crypto-backed assets is that crypto-backed assets are subject to the crypto market failing, and you no longer have the assets you need to back the tokens, because you're using these assets to buy the tokens when they're below price and issue the tokens when they're above price. The last way of doing it is algorithmic, and that's where smart contracts, and that's where you get into kind of derivatives and maybe market manipulation in some sense, and lastly, combinations of these. The only coin that comes close to this, the coins that come close to this implementation are Haven and BitShares. BitShares only does half of it. They don't let you convert back and forth. They just let you convert one way. That means it's very stable one direction, but not very stable the other direction. And Haven, which is looking at it more like a futures contract that you can then trade. So it's a futures contract on currency. So they're thinking of it in terms of debt or a currency contract. It's not really debt, currency contract. BitShares is the one that's thinking about it as debt. We're thinking about it as standalone peg tokens that are tradable against each other and just let the market do what it wants to do. And that's all my time, guys. Thank you very much, and I'd be happy to answer questions offline.